Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. Okay, friends, it looks like another shoe has dropped in the banking crisis of 2023. I don't even know if we can really call it a crisis. Maybe it's a mini crisis. Nonetheless, First Republic Bank was taken over by the FDIC. We have a really orderly transaction already in place with JPMorgan lined up as the buyer. I'm Jason Hall. This is The Smattering. And there's three things about this deal that I want to talk about that I think are really important for investors looking at banks, whether you're looking at JPMorgan or you're looking at other banks. All right, let's get right to it here. The first thing I want to do, I'm going to pull up okay, let's get right to it. The first thing I want to do is I want to pull up the press release and I want to highlight the deal details. So first of all, what did JP Morgan buy? So again, you see right here, $173 billion in loans, about $30 billion in securities. So those are the assets, right? About $200 billion in assets. Now, what they're buying, they're getting the assets, right? These are what generate the income. But what JP Morgan really wanted is the people, the customers behind these deposits, about 92 billion of deposits. You back out 30 billion, which all of the large banks deposited back in March to try to backstop First Republic when we saw Silicon Valley Bank and Signature Banks fail. So really it's getting about 62 billion of deposits that are actually tied to those high net wealth customers that it wanted. Okay. So what is it getting in return? Now, here's the thing. The reason First Republic failed is a ton of those loans and mortgage-backed securities were from loans that were written back in 2020 and 2021 at super low interest rates, right? So JP Morgan, it sounds like, paid a little bit of a market premium on those loans to get the customers, again, to get those customers here, but it had to get something in return. And what it got in return from the FDIC is this right here. It's a loss share agreement covering acquired single-family residential mortgage loans and commercial loans. Basically, the FDIC said, you need to pay a premium. You know, we're not going to book the market loss on these loans if you want access to those depositors, but we'll backstop you against losses, right? So now by paying a premium, the FDIC is going to make sure that they don't take big losses on any of those loans if we see a lot of foreclosures. Now, they're really high-quality loans, so it's probably pretty low likelihood, but getting that part of the deal makes a ton of sense. Going forward, looking for about $500 million of incremental income per year. That's what the folks at JP Morgan are expecting to earn from the deal. Okay, so that's done. Let's talk about the three things that stand out. Number one, this was incredibly orderly. I want to be sure the FDIC gets a ton of credit for how good they are at taking these really tough situations and making them as orderly for the depositors and taxpayers as they can, right? So kudos here. I'm a First Republic customer, so and a Chase customer too, actually, and it's been completely seamless. And I think that's really important. But that plays into JP Morgan's strategy. It has to be seamless. If this is not handled well, those depositors are going to leave, right? So managing those relationships, I think, is really important, and making it seamless is an absolutely critical thing to happen. Let's talk about the profitability aspect of it. That's number two. So again, expecting about $500 million a year in incremental net income as a result of this deal. An analyst pointed out on the call that they did to talk about the deal, that's about half as profitable as First Republic was before, right? So why is it half as much? Number one, Jamie Dimon said on the call, they're being conservative, which makes sense. You know, they need to be conservative with their expectations. And we need to remember, they're getting, I think we said it's like a net of about $62 billion in deposits. First Republic's already lost about $100 billion in deposits so far this year, coming into its earnings report last week. It's already lost a ton of those customers, right? So you have to just cross those out. That's profits from years before. Those customers are gone, right? So it makes sense it's not going to be as profitable as it was before, and management needs to be conservative, okay? Now let's talk about the third thing. This is the big question a lot of people have to be asking themselves. Is JP Morgan a stock to buy? Number one, I don't think it's worth buying based on this deal. This is a tiny deal. It's a couple $100 billion in assets for a bank that has trillions of dollars in assets. It's tiny. It's not a big deal for JP Morgan to swallow it up, integrate it, and nothing really changes at all, right? And it's probably a big reason the FDIC agreed to sell it to JPMorgan Chase, because it is just going to be so easy for them to integrate it. Now, looking outside of this deal, is JPMorgan Chase worth buying? it's trading for about 1.5 times book value. And frankly, that's like the top end of what I would pay for it, especially in this environment. If you look at the other mega banks, Bank of America, which I think is one of the best run banks in the country, and Wells Fargo, which has had its problems, but has largely gotten its house in order. They both trade for less than book value. They trade for between 93 and 97% of book value based on what I looked at some pricing today. They're trading for a discount to the book value of their assets. And they're both high quality banks, high quality businesses. And my expectation, if you were to buy any of these three banks today, hold for 3 years, hold for 5 years, through whatever economic uncertainty we have going on right now, through a full cycle of economic activity, the ups and the downs, I think that Bank of America and Wells Fargo probably outperform JPMorgan Chase, simply because the valuation. Valuation really matters for these really big mature businesses. So if I'm buying a bank stock today, it's not JPMorgan Chase trading at again, the top end of what I think is a fair value for it. I would be far more likely to buy Bank of America or Wells Fargo trading for a discount to book value. And I think I'm going to book better returns over the long term if I do that.